So you're doing it. You're taking that massive, exciting leap and starting your own law practice. First off, congratulations. That's huge. But amongst all the excitement of finding clients and winning cases, there's one area that is absolutely fundamental to your success and even your professional survival, and that's your tax obligations.
You're ready to be your own boss, right? To build a firm with your name on it and really make a mark. Well, before you get totally lost in the practice of law, there's this business reality that needs your full attention from day one. Think of it like the engine room of your firm. If it's not running smoothly, believe me, everything else is at risk.
And let's be crystal clear about the stakes here. This isn't just about owing some money to the tax man. For a lawyer, getting your tax wrong isn't just a financial penalty, it's a professional one. The legal profession uniform law says it right there in black and white. A tax conviction can lead to the suspension of your practicing certificate. We are literally talking about your right to practice law.
So to make sure that never, ever happens, we're going to walk through a simple roadmap. First, we'll pin down exactly what this obligation means for you. Then we'll tackle the single most critical decision you'll make at the start, your practice structure. After that, we'll break down the key taxes you'll have to manage, help you find a simple compliance rhythm, and then finally, we'll touch on some basic strategies to work smarter, not just harder.
Okay, let's dive into Section 1, a lawyer's tax obligation. And as we've said, this is about way more than just money.
So what exactly is a tax offense? Well, legally, it's any offense under the Taxation Administration Act. But here's the kicker for lawyers. A conviction triggers an automatic show cause event. In plain English, that means you immediately have to justify to the regulator why you should be considered a fit and proper person to keep practicing. It's a direct, unavoidable link between your tax affairs and your professional standing.
All right, with that in mind, let's move on to your first big strategic decision. Section 2, choosing your practice structure. Seriously, this is the foundation for everything else, and it has massive tax implications for years to come.
You've basically got three main paths you can go down. First, the sole trader. It's simple. You are the business. You just use your personal tax file number, and there's no separate tax return for the firm. Easy. Then there's the partnership. Now, it's not a separate legal person, but for tax purposes, it kind of is. The partnership files its own return, but then all the profit is distributed out and taxed in the hands of each partner individually. And finally, you have the incorporated legal practice, or ILP. This is a proper company, a separate legal entity. That makes things like bringing on new owners or planning your own exit way, way cleaner down the road.
So once you've picked your structure, it's time to get into the nitty-gritty of managing the money day to day. And that brings us to Section 3, managing your key taxes. This is the core financial engine of your firm.
We can really group the main taxes you'll be dealing with into three big buckets. There's GST, there's pay-as-you-go, or PAYG, and then, if you hire anyone, all the taxes that come with having staff.
Let's start with GST. The most important thing to get your head around is that for your firm, GST should be cash neutral. You're basically just a collector for the tax office. You add GST on top of your client fees, you claim back the GST you paid on your business expenses, and then you just pay the difference to the ATO. The number you have to remember is $75,000. Once your turnover hits that, you must register for GST.
Next up is pay-as-G installments. Now, listen closely because this is the classic trap for new business owners. In your first year, you might make a great profit, but you won't have a tax bill from the ATO yet. But then, in year 2, you suddenly get hit with the bill for year 1, and you have to start paying installments for year 2. It can create an absolute cash flow crunch if you're not putting money aside from day 1.
And this chart shows a related problem, especially common in partnerships, called debtor's lockup. See that big bar? That's the partner's taxable profit, the amount the tax office says they earned. But that smaller bar, that's the actual cash that's hit their bank account. That big gap is all the money tied up at unpaid client invoices. The painful part is you're paying tax on money you haven't even collected yet.
An ILP structure helps with that cash flow issue because it works differently. Here's the process. First, the company itself makes a profit and pays tax, but at the lower corporate rate. Then, whatever's left is paid out to you as a dividend. Finally, you personally pay a top-up tax to bring the total up to your personal marginal rate. It's a two-step process that gives you much more control. Now, the moment you hire staff, a whole new set of responsibilities kicks in. You've got PAG withholding.
That's the tax you take out of your employees' wages for them. You absolutely must pay their superannuation guarantee every quarter. Payroll tax, well, that only kicks in if your wage bill gets over 1.2 million, so you don't need to worry about it at the start. And be really careful with fringe benefits tax, or FBT. It's a massive 47% tax on non-cash perks, so just be mindful of that.
Okay, I know this can sound like a lot to juggle. So in Section 4, let's turn it all into a simple, predictable schedule. Let's find your compliance rhythm.
You know, when you lay it out like a calendar, it suddenly feels a whole lot more manageable. Your monthly beat is basically about staff stuff, PAYG and payroll tax if it applies. Your quarterly rhythm is dominated by your BAS statement, paying super and making that PAYG installment we talked about. And then, once a year, you've got the big ones, the firm's income tax return and your workers' comp insurance. See? That's the financial heartbeat of your firm.
All right, once you've nailed that rhythm and you're 100% compliant, you get to graduate to the next level. Welcome to Section 5, Basic Tax Smart Strategies. This is where we move from just playing defense to playing offense.
But you can't build a fancy house on a shaky foundation. You have to get the basics right first. Once that foundation of structure and compliance is rock solid, though, you earn the right to start thinking about optimization, about legally and ethically minimizing your tax bill so you can maximize your firm's financial health.
And this is just a little peek at what's possible down the line. We're talking about things like strategically timing the dividends from your ILP, or maybe even setting up more advanced structures like family trusts or service trusts. Now, these are complex, and they are definitely talk to your accountant topics, but they become powerful options once your practice is up and running smoothly.
So let's bring it all home. The main takeaway is this. Tax is not just some boring admin task. Getting your structure, your systems, and your rhythm right from day one is the absolute bedrock of a professional, sustainable, and ultimately a really successful law practice. It protects your license to practice, and it fuels your future growth.
And that really leaves us with one final thought to take with you. Building a compliant practice is your non-negotiable first goal, but the journey doesn't stop there. The real question for your future is, once you are compliant, is your practice truly optimized? Because that's where the real strategic thinking begins.